In 1929, the stock market crashed. In 2008, housing collapsed. In 2025, it's all of it: stocks, bonds, real estate, even the dollar itself. The entire system is breaking, and most people still think it as just a market correction. For the first time in history, every major asset class is inflating together, and all are now poised to collapse together. Economists call it the everything bubble, and when everything pops, there's nowhere left to hide. When the stock market crashed in 1929, bonds were safe. When housing crashed in 2008, stocks were booming. But in 2025, every pillar of the financial world is trembling at once. Why? Because the very system designed to protect us, central banking, has become the engine of its own destruction. This is not just another market downturn. This is a global rebalancing, an economic reset, decades in the making, and it's already started. To understand what's about to happen, we need to go back, not just to 2008, but to 1971. That was the year President Richard Nixon did something unprecedented. He severed the U.S. dollar's link to gold. Before 1971, every dollar in circulation was backed by real gold held in U.S. vaults. It kept governments honest. It prevented endless debt creation. But when Nixon ended the gold standard, money became an idea, not a promise. The result was a global economy addicted to credit. Overnight, the world entered a new financial era, the era of fiat money, and with it came the illusion of infinite growth. From the 1980s through the 2000s, every major crisis, from the dot-com bust to the Great Recession, was met with the same solution: print more money, lower the rates, bail it out. It worked temporarily. Each fix bought time, but at a cost. Like a patient kept alive with painkillers, the underlying disease kept spreading. The system no longer rewarded productivity or innovation. It rewarded debt. Governments borrowed, corporations borrowed, even consumers borrowed, to buy homes, cars, stocks, crypto, everything. By 2020, global debt had exploded past $300 trillion. And then came the pandemic. COVID-19 didn't create the crisis. It simply hit fast forward. In 2020, central banks printed over $30 trillion worldwide in just 18 months. That's more money created out of thin air than in all of modern history combined. It propped up markets. It saved Wall Street. But it also unleashed an invisible time bomb: inflation. The rich became richer. Asset prices soared. Meanwhile, wages stagnated, rents exploded, and the cost of living spiraled out of control. By 2023, the average American family needed 2 incomes just to maintain what one income could afford 20 years ago. And now, as central banks try to fight the very inflation they created, they're raising interest rates into the most over-leveraged system in human history. The result is a global financial structure shaking at every level, from small banks to massive sovereign debt markets. But here's the twist no one's talking about. The danger isn't just economic, it's systemic. Because when you inflate everything, when every asset class rises on cheap money, a single crack can bring the entire structure down. And those cracks are already forming. Stock markets are showing volatility not seen since 2008. Real estate prices are cooling worldwide. Bond yields are at 20-year highs, and central banks are trapped, unable to print without reigniting inflation, unable to stop without triggering collapse. We're approaching what economists call a liquidity trap, a situation where no policy, no rate cut, no bailout can fix the damage. Because the real problem isn't just too much debt, it's that the money itself has lost meaning. History doesn't repeat, but it rhymes. And every great financial empire, Rome, Spain, Britain, collapsed the same way. Too much debt, too much pride, too late to change course. The U.S. is next. When a system becomes too big to fail, it also becomes too big to save. That's where we are today. Governments are trapped between 2 impossible choices: If they print money, inflation will spiral out of control. If they stop printing, the debt bubble will implode. Either path leads to collapse. Only the shape of the disaster changes. But to understand the danger ahead, you have to see how every decision of the last 50 years has built this moment. Step by step, crisis by crisis. After Nixon ended the gold standard, the dollar became the world's dominant reserve currency. Other countries started holding U.S. dollars and U.S. Treasury bonds as their core assets. That gave America a unique superpower, the ability to print money that the whole world would use. It worked beautifully for decades. The U.S. could borrow endlessly, spend without limits, and run trade deficits while everyone else accepted its paper in return. The world sent its goods to America, and America sent dollars back. But that system created an illusion. It made the U.S. appear richer than it really was. It allowed the government, corporations, and consumers to live far beyond their means. The rest of the world played along because everyone benefited. China got exports, Europe got stability, and Wall Street got rich, selling the debt that fueled it all. But every empire that lives on borrowed time eventually faces the same question. Who will buy the debt when the trust runs out? We saw the first cracks in 2008. The global financial system nearly collapsed when toxic mortgages triggered a panic that spread across the world. Central banks stepped in, cutting rates to zero and launching quantitative easing. Trillions of dollars flooded into markets. It saved the system, but it didn't fix it. It just made the bubble bigger. Instead of reforming, the same institutions doubled down. Wall Street learned the wrong lesson, that no matter how reckless it became, the Fed would always bail it out. So the cycle continued. Cheap money led to speculation. Speculation led to bubbles. Bubbles led to crashes. And every crash led to more cheap money. It was a feedback loop, one that replaced real economic growth with financial engineering. By the 2010s, companies weren't investing in innovation. They were borrowing to buy back their own stock, artificially boosting prices while burying themselves in debt. Politicians didn't care. As long as markets stayed high, voters stayed calm. Central banks didn't care. As long as inflation stayed low, they felt in control. But low inflation was a mirage. Technology, globalization, and cheap Chinese labor hid the real cost of money printing. For 30 years, goods got cheaper even as debt exploded. Then the illusion broke. When COVID-19 shut the world down, the entire system froze. Supply chains collapsed. Factories stopped. Yet stock markets, unbelievably, soared to record highs. Why? Because trillions of new dollars flooded in. Stimulus checks, corporate bailouts, massive asset purchases, all financed by debt and digital money creation. The result was the biggest transfer of wealth in human history. In less than 2 years, global billionaires increased their wealth by over 60%. Meanwhile, half the world's working class fell deeper into debt. And then came inflation, the monster that decades of economists had convinced themselves was extinct. By 2022, inflation hit 40-year highs across the developed world. But the real shock came when central banks tried to stop it. The Fed began raising interest rates faster than any time in modern history. That single decision exposed just how fragile the entire system had become. Because when debt levels are this high, even a small rise in interest rates becomes catastrophic. Governments have to pay more to service their debt. Corporations have to refinance at higher costs. Consumers stop spending, and the dominoes start to fall. We've already seen the first wave: regional banks collapsing, mortgage defaults rising, commercial real estate prices plunging. But that's only the beginning. The real risk isn't visible yet. It is buried deep inside the plumbing of the financial system. Shadow banks, derivatives, and leveraged funds, all interconnected, all dependent on the same cheap liquidity that's now drying up. And when liquidity vanishes, trust follows. That's when panic sets in, just like in 1929. just like in 2008, and just like every empire before collapse. The U.S. economy today runs on what economists call confidence-based money. It only works as long as people believe it works. Once that belief breaks, no central bank, no politician, no policy can restore it. That's what makes this crisis different. It's not about subprime loans or bad actors. It's about the foundation itself, a monetary system that has been hollowed out by decades of easy money. When you print trillions, you distort everything. Prices stop reflecting value. Risk stops reflecting danger. And debt stops reflecting reality. It's a financial hall of mirrors. And every reflection looks stable until it shatters. The warning signs are everywhere. The bond market, once considered the safest place in finance, has seen historic losses. Governments from Japan to Italy to the U.S. are now paying more to borrow than their economies can sustain. Meanwhile, corporate bankruptcies are rising, household savings are evaporating, and consumer debt has hit all-time highs. People think 2008 was bad because the housing market collapsed. But this time, it's not one market. It's the entire system: the stock bubble, the bond bubble, the housing bubble, and the debt bubble. All inflated by the same force, artificially cheap money. And now, as that cheap money disappears, everything that depended on it begins to crack. The irony is that central banks are trapped by their own success. They've spent decades convincing the world that they can control everything: interest rates, inflation, growth, even market psychology. But now, every move they make only accelerates the collapse. Cut rates, and inflation comes roaring back. Raise rates, and debt implodes. Do nothing, and confidence fades. There's no escape. Economists call this a policy doom loop. It is what happens when the system becomes too interdependent to fix, and too fragile to survive. Meanwhile, most people have no idea how close we are to the edge. They see record stock prices and assume the danger is over. They believe the headlines that say, "soft landing." But history tells a different story. Before every major crash, there's a calm, a false sense of stability. Before 1929, newspapers declared a new era of prosperity. Before 2008, the Federal Reserve said the housing market was strong. And today they're saying the same thing again. But beneath the surface, the cracks are widening. The global financial system is like a dam holding back a flood. Each new policy patch adds pressure instead of relief. And when that dam breaks, it won't be local. It will be global. That SY 2025 and 2026 are shaping up to be the most dangerous years in modern financial history. Not because of one event, but because of a chain reaction already in motion. Decades of debt, years of manipulation, months of rising pressure, and a single spark, anywhere, could bring it all down. So what could trigger it? It might start with a currency shock, a sudden loss of faith in the U.S. dollar, or a bond crisis, where nations stop buying U.S. debt. Or maybe a major bank default that ripples through the global system overnight. No one can predict the exact match, but the conditions for the fire are already set. Let's imagine how this collapse could unfold. It starts quietly, like all major crises do. A sudden sell-off in government bonds. Investors panic, not because of bad news, but because they sense something's wrong. And yields spike. The cost of borrowing for governments skyrockets. At first, central banks rush in to reassure the public. They say, "The economy is strong. This is temporary." But markets don't believe them. The world's biggest debt market, U.S. Treasuries, begins to wobble. That's the unthinkable scenario, because when treasuries fall, everything else falls with them. They're the foundation for global finance, the collateral behind trillions in loans, derivatives, and corporate debt. When that foundation shakes, the entire pyramid begins to slide. Banks start tightening credit. Companies can't roll over their loans. Layoffs begin. Consumer confidence collapses. And the first dominoes start falling. regional banks, overleveraged funds, and shadow lenders. It's a global margin call. Everyone sells what they can to cover what they owe. But there's a problem. When everyone sells, there are no buyers left. Asset prices plunge. Stock markets lose 40%, then 60%. Real estate freezes as buyers vanish. Even government bonds once seen as safe become toxic. And this time, there's no cavalry coming. In 2008, the Fed stepped in to save the system by slashing interest rates and buying trillions in assets. But today, inflation ties their hands. They can't print without igniting another surge in prices. So they hesitate. And that hesitation turns fear into panic. Global trade slows. Currencies fluctuate wildly. Emerging markets implode as the dollar surges. And the whole world realizes the system that held everything together has broken. This is how an everything bubble becomes an everything crash. But here's the cruel irony. Even as markets collapse, real inflation doesn't disappear. It shifts. Food and energy prices rise as currencies lose trust. People can't afford basics, even as their investments evaporate. Savings vanish, retirements are destroyed, and what began as a financial crash becomes a social one. You see, every great economic collapse in history eventually becomes political. In the 1930s, the Great Depression fueled extremism and war. In 2008, it gave rise to populism and distrust in institutions. And in the 2020s, it is likely to create something even more unpredictable: a total loss of confidence in the very idea of money. When people stop believing in their currency, they look for alternatives. In Rome, it was gold and silver. In the 1970s, it was oil. And today, it might be digital, Bitcoin, CBDCs, or something entirely new. That's the real battle of this decade. Not just economic, but monetary power itself. Governments know this. That's why central banks around the world are rushing to launch digital currencies. Programmable money, fully traceable, fully controllable. It is the system as a survival mechanism, a way to rebuild control after the old order collapses. But every reset comes with winners and losers. Those who see it coming can adapt. Those who don't become part of the history books. Let's go deeper. Every empire ends the same way, not with invasion, but with overextension. They spend too much, borrow too much, promise too much, and when reality catches up, they print money to delay the inevitable. But money printing doesn't erase debt. It only shifts it, from banks to governments to citizens. That's exactly what's happening now. Governments are absorbing private debt through bailouts and subsidies. Central banks are absorbing government debt through bond purchases. And when that cycle reaches its limit, there's only one place left for it to go: into the currency itself. That's when inflation becomes permanent. That's when confidence dies. That's when money, as we know it, ends. Think back to 1929. When the market crashed, the system was brutal but simple. There was gold. There were banks. There were no bailouts. It was painful, but it cleared the system. Now, we've created a machine that never resets. It just transfers the pain forward. We don't allow failure anymore. Not for banks, not for corporations, not even for governments. And because of that, the eventual collapse is not smaller. It's bigger. Every bailout increases the next crisis. Every rescue builds the next failure. Every fix becomes the seed of the next disaster. The everything bubble isn't just about money. It's about a civilization that has forgotten the laws of consequence. We've replaced saving with spending, work with speculation, value with velocity. And now the bill is coming due. As 2025 approaches, the warning lights are flashing red. The yield curve is inverted, a classic sign of recession. Global shipping is slowing. Corporate bankruptcies are at decade highs. And household debt has surpassed the levels that triggered the 2008 crash. Meanwhile, governments keep insisting that everything's fine. They say inflation is under control. They say unemployment is low. They say growth will return soon. But the numbers tell a different story. Real inflation, including rent, energy, food, and health care, is far higher than the official figures. Job numbers are padded with part-time and low-wage work. And economic growth? It's fueled almost entirely by government spending, borrowed from the future. This isn't recovery, it's desperation. And here's the pattern. Every time an empire reaches this stage, massive debt, fake growth, widening inequality, the outcome is the same. Rome debased its silver coins until their value collapsed. France printed assignats during the Revolution until no one accepted them. Germany's Weimar Republic printed marks by the trillion, destroying the middle class. And today, the U.S. is doing the same thing, digitally. The form changes, the math doesn't. Once debt grows faster than the economy's ability to pay it back, collapse is only a matter of time. The only question is what form it takes: inflation, deflation, or both. In the short term, deflation looks likely. As credit contracts, asset prices fall, and markets crash. But the response, the inevitable money printing, will ignite the opposite: hyperinflation. That's the paradox no one's ready for: a world where asset prices crash, but essentials skyrocket, where savings vanish, but debt remains, where the currency still exists, but trust in it doesn't. And when trust dies, everything built on it dies too: pensions, insurance, banking, trade, politics. This is why historians say every financial collapse is, at its core, a moral one. Because in the end, it's not numbers failing, it's people, it's institutions, it's belief. And belief is what holds civilizations together. For now, people still believe in the dollar. They still believe in the Fed. They still believe that somehow, someone, somewhere will fix it. But faith is fragile. And when it breaks suddenly. No warnings, no countdown, no recovery plan, just silence. Then panic. Then history repeating itself all over again. When faith in money breaks, societies enter what economists call a trust vacuum. In this vacuum, power shifts rapidly, from governments to whoever can offer stability. That might be corporations, tech giants, or even decentralized networks. And that's the real danger of the 2025-2026 crash. It's not just about markets falling. It's about who replaces the system that falls. Because make no mistake, after this crash, there will be a reset. But the question is, who will control it? Let's connect the dots. When Rome's denarius collapsed, emperors responded by centralizing power, tightening control over trade, land, and taxation. When Britain lost its empire after World War II, America replaced it, and the dollar became the new global reserve. When the 2008 crash hit, central banks gained enormous power, deciding which companies lived and which died. And now, in 2025, we're approaching the next transition, from traditional money to programmable money. That's the endgame of central bank digital currencies, or CBDCs. They're sold as modern and efficient, but they're also the perfect control mechanism. Every transaction traceable, every account adjustable. Money that expires, freezes, or locks, depending on government policy. During the crash, this new system will be presented as salvation. Don't worry, they'll say. Your money is safe in the new digital system. People desperate for stability will accept it, just as they accepted every previous fix. But history warns us. Every reset that begins as rescue ends as control. In the 1930s, gold was confiscated for the good of the nation. In 1971, convertibility was ended to stabilize the economy. And in 2008, quantitative easing was introduced to save jobs. Every time, the promise was temporary. Every time, the consequences became permanent. Now, imagine this next version. programmable currency controlled by algorithms, managed by AI-driven central banks, optimized for economic stability. The question is, stability for whom? Because systems don't crash evenly. They crash hardest on the people who trusted them most. The middle class, the savers, the pensioners, the ones who believed the system worked. Meanwhile, the insiders, those who see the shift early, quietly reposition. They don't panic. They prepare. They move out of paper assets. They reduce leverage. They buy real value: land, energy, commodities, and skills that survive resets. That's what happened after every historic collapse. The Rothschilds emerged stronger after the Napoleonic Wars. The Rockefellers thrived after the Great Depression. And in 2008, while millions lost homes, the top 1% bought them back at pennies on the dollar. The pattern is brutal but clear. Crisis is the transfer of wealth from the unprepared to the prepared. So, if this everything crash is indeed coming, what can we learn? Let's distill this story into 3 simple takeaways. Takeaway 1. The system is more fragile than it appears. The illusion of stability we see today is built on artificial confidence. Markets aren't rising because of innovation or productivity. They're rising because of liquidity. Money printing, buybacks, and government subsidies have created a market disconnected from reality. When that artificial support is withdrawn, by inflation, by political paralysis, or by simple exhaustion, the real economy will reappear. And it will look nothing like the charts we've been shown. That's why 2025 to 2026 is so dangerous. Because all the buffers that saved us in 2008, rate cuts, stimulus, bailouts, have already been used. There's no cushion left. The only thing holding the system up is belief. And belief is the most unstable foundation of all. Takeaway 2. Crashes don't destroy wealth. They transfer it. This is the hidden truth of every financial collapse. Money doesn't vanish, it moves. From paper to gold, from stocks to commodities, from weak currencies to strong ones. In 1929, those who held cash bought assets for pennies. In the 1970s, those who owned commodities survived inflation. In 2008, those who bet against the system, or held real assets, gained while others lost everything. The same will happen again. That's why understanding cycles is more important than chasing returns. History doesn't repeat perfectly, but it rhymes with frightening precision. And if you can see the rhyme before others, you can step aside before the avalanche hits. Takeaway 3. The reset will be psychological, not just financial. The next crash won't just reset numbers, it will reset trust. People will begin questioning what money really is, what value means, and who deserves control over it. And in that questioning lies opportunity and danger. Because when people lose faith in old systems, they look for new ones. Some will look to Bitcoin, some to gold, some to the state's digital money, some to parallel economies built on barter, community, and independence. What will emerge is not just a new financial system, but a new world order built around control of trust. And that's why this crash could be worse than 1929 and 2008 combined. Because it just destroy wealth. It will destroy faith in the very structure of modern civilization. So where does that leave us? It leaves us here, at the edge of a transformation bigger than most people can imagine. A transformation that's been building for decades, hidden under the noise of markets, politics, and headlines. We are living in the final stage of a system that no longer serves its foundation: real value, honest work, sound money. And when those foundations crumble, history doesn't stop. It resets. But remember this: every collapse also marks a beginning. The end of Rome gave birth to the Renaissance. The Great Depression fueled decades of innovation, and the 1970s chaos set the stage for the digital revolution. The question isn't whether a collapse will come, whether I'll be ready when it does. So, as you watch the markets, the headlines, the endless reassurances from officials who say, everything is fine, remember, empires never fall overnight. They decay quietly until one morning everyone wakes up to realize the world has changed. The 2025 to 2026 crash won't just be another recession. It will be the moment the world finally confronts the illusion it built its prosperity on. The illusion that debt can be infinite, that money can be printed forever, that confidence can survive without consequence. It can't, and deep down, we all know it. So, as the next storm approaches, protect your wealth, yes, but more importantly, protect your understanding. Learn history, recognize patterns, and remember, those who see the collapse early aren't the ones who panic. They're the ones who prepare, because when the everything crash arrives, and it will, the real asset won't be money. It'll be foresight. So ask yourself, when the system resets, will you be part of the panic or part of the preparation? If you found this video insightful, don't forget to like, share, and subscribe. Because understanding history isn't just about the past. It's the only way to survive the future. This is the story of the next great crash, and how to see it before it sees you.